I think weekly works best for forecasting. Again, I'm not a day trader, so I'm not interested in even there's too much erratic action. I think for day trading, very short term, too erratic, it's way too random. So I like to work on weekly data. And cycles are better at timing than magnitude. We talked about that earlier. Remember, cycles measure time, 32 days, 62 days, 435 years, whatever. They don't measure price movement this way. They measure primarily time. So they're not really good at magnitude. So the fact that we're high, low, that's just the way cycles operate. It doesn't mean you're going to have a huge rally. It means we should have a bullish influence from here to over here. But we'll show that with a line, of course, that goes up. They're not a be-all, end-all. I see them as a setup tool. And they are not good, at least in the stock market, at predicting tops. They might even be miserable at predicting tops in the marketplace. And here's why. It's a really important point. So many people have called the top in the market using a 7-year cycle and the market never topped, or a 10-year cycle, or an 8-year cycle, or whatever. Why? Because the stock market shows a strong upward drift, upward bias. It always goes up. So the tops we do get in the market don't last very long. The 2008 decline lasted, what, 9, 10 months? That was it. And the market went right back up again. So cycles, at least for the stock market indexes, don't call market tops very well. That's where I think we could bring in fundamental data that is a lot better job of calling market tops than trying to call market tops with cycles in the stock market is really hard. Now, commodities are different. Commodities are they go up and they go down. They're boom, bust, because commodities go from oversupply to undersupply. So they're very erratic. They don't have long-term drift. You look at the price of sugar, goes up, comes down, goes up, comes down. Wheat, the same thing. Years ago, Jimmy Rogers had a commodity fund. He said, "Oh, commodity will go up in this great big commodity bull market." They didn't. They went up, down, up, down. When there's too much wheat, prices come down. And if the wheat's too high, people will, or say cattle too high, they'll buy pork or chicken. And so then nobody has cattle, and there's no cattle, and then cattle goes up because nobody had any cattle to produce cattle. Commodities are a boom-bust market. They cycle differently than stocks. Gold, a boom-bust market. Gold is driven by commercials. It's a commodity that's used, consumed, and produced. I love Sean Hannity. I love to listen to his radio show until they put on the gold commercials. Buy gold, it'll protect you from that. Gold's a commodity. It goes up and it goes down. I hate to spoil your dream about gold protecting you. It isn't going to protect you from anything. Oh, when we inflate, gold will go way up. We inflated the last 2 years and gold went down. Well, how about in a major stock market crash like 2008 when gold went down, or the panic of 2020, gold went down, or the crash of, whenever markets crash, gold crashes too. So there's this whole emotional thing, which is an old wives' tale, that in a recession, gold will go up, and no, it goes down. In a stock market panic, gold will go up, no, it goes down. And I used to think in inflation, gold goes up, because it did, until about 10 years ago, we would inflate and gold wouldn't go up. I believe gold is a commercially driven market. So you want to look at the commitment trade report, look at cycles. There's some strong cycles in gold. You want to focus on that if you're going to focus on gold.